Want to just also remind you to write down any questions you have. Also note the page number, the keyword there. Keep a list with you. Okay. Obviously, we're going to get to question and answer session during the week, but this is the place or quick reminder to do that. Also, just to let you know, this next section is going to be about an hour in duration. This is the pivot point starting on page 146. And then we will have one last section, which will be close to an hour and a half. So they're longer sections, obviously. Today's session only having 3 segments. Real quick, while we're just about to get started, let me just get a quick raise of your hand. If this is the first session you're attending today, you were not at the earlier session. Just want to try to get an idea of how many unique visitors are there from today. I mean, for now, not earlier today, just how many of you are seeing it for the first time. All right, perfect. With that said, then, I think we're ready now to get going with the pivot point section, page 146 of the workbook. And here we go.
Okay, hello, we're back, and we're going to start off by talking about the pivot points. So in case you don't know what the term pivot point means, it's essentially it's an actionable area. It's a tight price point at the very right. It's the very last spot on the chart on the very right side, and that's what David was talking about, that when we're screening, we're looking on that right side. So we're kind of looking for pivot points before anything, except of course the stage 2 uptrend, which we've already determined those stocks are in that uptrend, and now we're looking at stocks that are in an uptrend and forming bases and looking for that tightness on the right side. Now, the pivot point could form at the highs of a base, or it can form a little bit lower. We're going to talk about how you differentiate that. And again, it can form with a confluence of a bunch of price action coming right across that equals the pivot point's high, or it might be a little bit lower. And I'll show you that in just a second on how that plays out in real life.
And Mark, another definition of pivot is just the buy point. It's as simple as that. That's right.
That's right. We call it the pivot buy point. But pivot points go all the way back to Jesse Livermore. He used them in a little bit different way than I'm going to explain to you. But pivot point, the term pivot point, is a very old term. Let me show you a name here, AMSC, American Superconductor, that came out of a really nice formed VCP. And remember, like I said yesterday, or I said in the previous session, everything that we talk about builds on what we talked about previously. So again, stock is in an uptrend, VCP action, and now pivot point on the right side, tightening up and coming out of that tight price action. That's your actionable, that's your buy point. That's where you're looking to buy the stock as it breaches the upper highs of that pivot point. Now, as Dave, as you said many times, you can sometimes just draw a line across the top of the price action. And if you have an area where it's bumped against a bunch of times, like here, you can see it reversed. You can see it also, daily reversal here, and each time it's coming back, and like we spoke about how the towel's getting tightened and the water's coming out, you can see that happening here. It's getting tighter and tighter and tighter until finally the price is very, very tight, and now you see how it can explode out of there. Look at this second day, this follow-through day, just a huge move coming out of there, and that's because you have a lack of supply. So now even a small amount of buying can move the stock, and you can see right here there's an enormous amount of buying. I mean, you want to talk about, wow, look at that, Dave, that's a tower just coming out of there. So explosive move, and again, that's not the average investor buying stock there. Those are institutions.
Yeah, and Mark, I just want to kind of expand on that point that you mentioned, that I talk about just draw the line. Because a lot of people, they're looking for cups and handles. They're looking for double bottoms. They're looking for W formations and all these different terminologies, or where's the saucer? And I say, make it as simple as possible draw a line across the majority of the tops. Where 90 to 95% of the base is being built below a certain point. Just draw that line going across, and sometimes that line is being drawn down a little bit to the right. It's a little bit of a downtrend, but I just try to simplify it and just draw that line, just as Mark has that drawn on that American superconductor. That's where your pivot buy point is when it goes through that line.
Right, and we're going to show you. We're going to draw a bunch of lines here. Actually, if you take a look right here, I've drawn a line right across here where the pivot point is forming. But you can see that the VCP action started from way over here on the left side in November, December. Here's 1, 2, 3, 4. So you've contracted down to a very tight price. But now, do you see how it's not a coincidence or a surprise that it's exploding out of the tightest part of the pattern on the right side when it's fully developed, and you've gotten that very tight single digit price tightness? You see that when you see these charts over and over, you're going to find that that's where the explosive action comes from. So that's what we're looking to do, is to time that trade so we're very quickly at a profit. All right. And of course, that's helping with risk because we're at a profit. Now our options open up. Now we can move our stop to break even. There's all kinds of things we can do once we're at a profit. So that's the key, is to time these trades. And the best thing to time them with is tight price action coming from these pivot points and buying when they come through the pivot point. Now,
yeah, Mark, if you could just go back, I just go back to that. Yeah, this, now I say, well, okay, why did Mark draw the line right here at this being the pivot point? Why didn't he draw it at this high?
Yeah, well, I don't see a pointer there. So if
you don't see my pointer, okay, well, it's let me try stamping it.
Yeah, so you're talking about this high right here. Yeah, why not? Yep, I got you.
Yeah, why not that high right there? Do you see that? Do you see my X?
Yeah.
Okay, and then, and why not that high? Well, the majority of the highs are all built below 70. So that's where you should be drawing your line. You don't have to draw it at 71 or 71 and a half.
So we come right across here.
Yeah.
Look at how it only traded above that point twice. 2 times, and it didn't even close above it.
Right. And that's that. I just for clarity, that's why you're drawing the line at that point.
That's right. And as Dave said, now why not draw the line a little higher? Okay, so now let's say that you get a tight pivot point like this right here, but you have some price action to the left that's a little bit higher. Well, you have to ask yourself, what is the benefit? Like if you're talking about saving 1/4 of a point, wait for it to go through this high. Let it clear all the highs within that area of the base. And again, let's do that again. Let's draw another line here across. And let me get my tool here. I want to show you something. So if we take this and we come straight across, even here, you see it's only traded above this area way back here. But since it started putting in this base, you see it doesn't trade above that area. That's where the majority of the price action stalls. Comes up to that area, stalls. Comes up to that area, stalls. Comes back. See, that's where the supply is. That's where you want to tighten up into. So very important to remember what we talked about before, where I said when you have the supply, when you see a clear cut that there's an area that where you call it resistance, resistance, support. I call it supply, an area of supply. And when you tighten up and you're able to move sideways for a number of weeks or even months, and you tighten up on that right side and the volume comes down, it's telling you that there's a good indication that supply has stopped coming to market, that this supply has been worked through like the wringing of the towel. So we're going to keep going back to that concept over and over here. Again, taking a look at baby stores. This is back in 98. I bought it coming out of this base here. Worked out really well. You can see it went up almost 200% in 5 months. So again, the pivot is just a little bit below these highs, but not much benefit of buying it. You can also, sometimes when the pivot is a good distance lower than maybe some previous price points that are close to the pivot point, you can buy part of your position. So you can take maybe half of your position as it takes out the high and the pivot. And then when it gets through those other highs, you can add to it and you'll get an average price in between those two, which in this case, is very, very tight. Let's take a look at BB stores. It came out, that's right here, that's that base. Let me get my other pointer here. That's the base that we just looked at. You can see came right out, very nice, a bunch of days up, little pullback, right back into new high ground. And then you got a little base right here. See, the exact same thing happens where you get that little pivot point and you're seeing the volume. Remember how Dave was talking about the volume contracts in the pivot point, then expands. So you got the contraction, the expansion, same thing here, contraction, expansion. And then over here, you get a few pivot points. You get one right here, and you get the contraction, the expansion, and another one sets up here, which is more of a classic handle. So again, you might get a bunch of buy points in a move. Maybe you're trading in and out and you buy the stock, you trade out of it, you come back into it, out of it, come back into it and out of it. Or you hold the stock and you go through these later buy points and you're not adding to your position. Or you might also trade around your position. Maybe you take off a little bit of your position and then put it back on. There's a lot of different ways you can do it. But like Dave said earlier, you're going to get yourself, in a good stock move, you're probably going to get yourself a number of buy points.
Yeah. The other thing, Mark, is so interesting about this chart. I mean, if you just look at the colors, you can see the blue is up days, the down is red days. And if you just look at how many blue volume spikes there are and how few, negative down, red spikes there are, it just that alone, and that's so what's great about MarketSmith. And Mark, I mean, maybe not to date ourselves, but I still remember, all the charts were in black and white, and until things started going to the computer, until you got you got colors on your computer, it would actually be harder. You would have to look at every single day and see, is that an up or is that a down volume? But now it's so much easier because you get this color coded and you can change the colors if you want to. So look at the colors. That gives you a great indication of an uptrend or downtrend.
Yeah, it was very hard to decipher that back in the day, as we call it. And Dave and I both started off with paper charts, in the daily graph books, where we'd have to go through these little tiny graphs, and then throughout the week, imagine where the stock price was, because we would only get them weekly. So it was you had to use your imagination.
Yeah, you had to mark them up yourself as every day went by.
Yep.
Now these things are updating, every tick.
Yes, and those were in black and white also. So let's look at some more pivot points here, and also let's start looking at, because we're zooming in now. We're coming into that really close look now, and let's take a look at the volume. Dave, you can go wild on volume now. Now we can analyze volume more closely. So you're seeing, and I call it the 1-2 punch. I'm going to show you that in just a second. But where you have the 1 is the contraction, the 2 is the punch, as it comes out of that base and out of that pivot point. You want to see volume expand. You don't necessarily have to have it on the breakout. Sometimes it happens a day or two later, but you want to see volume expanding as the stock's coming out. And most of the better stocks, the ones that make really good moves, really come out explosively. And you can see that very clearly here, the contrast in volume. Let's look at another one. And some of these charts, if you look at them, you take a look at this here, new EDU, and compare it then, and we go look at this next chart, MELI, they look very similar. It almost could be the same stock. But again, going through the VCP, very tight right here, and you can see the 1-2, right? You get and that last day before it breaks out, look how it's just about the lowest volume that it's traded in the entire stock's life. Sometimes with small cap stocks, you'll get no volume. You get it down to trades just a few shares, and that'll make some people nervous. It's it's not liquid enough. No, you want that illiquidity at that particular point. That's what creates the explosive potential. That's not your average daily volume. That's way below your average daily volume. And one particular day.
Well, go back. Yeah, look how big that volume is. I mean, that's over 4 million shares traded. And as what Bill O'Neill always used to say, that's not your Aunt Susie down the street. That's got to be large institutions, hedge funds, mutual funds, all in there on the same day buying that stock. And then you get you get the follow through on these 2 days after it goes up and tightens up again.
Yeah. I think I used Aunt Betty before.
Betty, no, I think it was
someone's aunt wasn't buying there and moving that stock. So taking them back, we'll bring them back to American Superconductor. We looked at this earlier. This moved up 60% in just 17 days from here. Again, you see how efficient that move is, very quickly. But here's the 1-2 where you have the volume is down to almost nothing, and then it comes in and comes out of that perfect VCP. Another one, looking at Impax Labs. Almost identical price action, very, very similar. These chart patterns, when you look at them, a lot of them look, it's like a fingerprint. You look at a fingerprint and they all kind of look the same, when you look at them from far away. But if no one is the same. But again, same thing with charts. No one is exactly the same, but there's some real similarities in there that are quite amazing.
And Mark, are you seeing, I drew another line going across where, do you see my line, or is that?
Yes. Yep.
Oh, you see it. Okay. See, I'm buying here, and remember, and that's over the majority of highs that have been built over the last 4 months. This is just, this is 5 or 6, maybe 7 or 8 days above higher, but the majority of that base is all right below here. And so when it's going through that, that's where your buy point is.
Right. And again, if you bring this all the way over, you see it only traded above that area for a short period of time, and then it bumped against that level. And now you can clearly, draw lines and see where support and resistance is. But the key is timing the trade, timing that when is the right time to buy it at the precise time that the stock is going to move. I get a lot of comments over the years, people say, well, how do you buy these stocks and they move right away? They think, I must be manipulating the stock somehow or something. Now people say, oh, I put it on Twitter and, everybody went in it. It's not true. It's just been happening, this way since I was trading a little small account and didn't tell anybody my trades. This is just the law of supply and demand and finding what is called the line of least resistance. Once the line of least resistance is formed and you go through this process, you're setting up a stock for a potential strong move. It doesn't mean it's necessarily going to move, but if your homework is right and the stock is in a strong uptrend and institutions do have an appetite for it, well, then it's going to explode. Once it goes through these type of characteristics and volume dries up, you're going to get an explosive move because even a little bit of volume will move it up from there.
And Mark, my expectations, if I've read the chart right, my expectations is that when I buy that stock, I should almost be making money immediately. And it used to be by the time you got your confirm back from your broker or whoever the trader you put it in from, you should be up. But this is, from the moment you get that execution, you should start seeing a profit. That's when you're really reading the chart correctly.
That's right. That means you've timed it correctly and the conditions are right. And here's a perfect example. Netflix coming out of a perfect VCP. You see setting up on this right side. There's the 1-2. You get the volume comes in, volume contracts in the pivot point, and then you see right away the stock moves up and closes and has a good close. And right away you're at a profit. You're going to see that pretty much in every one of these charts. So when you're looking at precedents of real great moving stocks, looking at Shopify here, and this is a really nice pivot. And again, let's draw a line. I think you were doing that, but
you want me to do it? I did it.
I got it right here.
Yeah.
So right. So let's see. Let's draw a line across here. Now take a look where I'm drawing the pivot. Take a look here. You see how? Go ahead. Explain it. How this is really just bumping against this same area over and over.
Yeah, and a lot of these closes. It went above that line. At this point right here. Whoops, let me.
I don't see your.
Yeah, right. I got it. Here we go. Right there, and then again right there, and here. But in most cases, except for this one time, it only stayed above that line for on one day. The majority, almost everything, was below that line, and so that's why we say this is the pivot, where the tightness comes up and it breaks all those highs.
Right, but there's only one spot where it tightened up real nicely around those highs. Volume came in and it gave you that actionable buy point, and that's when the chart is completed. Now, right here, it might have completed right here. If this tightened up right here and maybe had one more tightening, you might have had a setup right here. But and of course, it would have had to move up and break out first. That's another thing we should point out is you don't want to guess. You know, like you could have said right here, okay, well, this is setting up, it's tightening up, the volume's coming in, but you have to wait until it moves and it gets above that high and above that pivot point. Don't try to guess and cheat ahead of it. I'm going to show you, actually, there is something called the cheat, and we're going to get into that in just a second. But you don't want to cheat by buying it in the pivot. You want to get it moving out of the pivot to make sure that it's clearing that pivot.
One other really important point. You see how this tightening up here was just kind of drifting down, just like this. It should either go sideways or down, just drifting down a little bit before it turns and breaks out. Now, what was going on here, it looks on this side of the chart, this was actually kind of wedging up. And it's very subtle, but it just does not have the same look as over here. This is drifting down. This is drifting up. And this is what happened. If you had bought this saying, oh, I think that, it's breaking out of this base, well, on that very day, it reversed and then started coming back down again. So there's certain looks, and that's why it's so important to study these pivot points to see exactly what's going on in those spots.
And you can see the volume, the huge contrast in volume here in the pivot, and then when it comes out, again, a huge tower there coming out of there. Let's take a look. Quest Communications. I bought this back in 98, and you can see it tightens up, gets really, really tight here on the right side, has the volume characteristics, and then comes right out of there really strong. And again, just, classic, the same, you'll see the same thing over and over. And like I said before, they're like fingerprints. They're not exactly the same, but you can see that right side, how it tightens and it goes through that volatility contraction is consistent throughout. You're going to see it over and over and over. And we'll just keep looking at these over and over. Here's Nightbridge, which moved up 44% in just 12 days. And again, if you can get moves of 25, 30, 40% in just a week or two, just think about the compounding. And that's the key, is to get as quick of a gain as you can, as well as magnitude. Let me see here. I want to just show. Now, you can sometimes get multiple pivots. People often ask, well, do you pyramid buy? You might have heard of pyramid buying, adding to your position as it moves higher. I don't add to my position just because it moves higher. I'm not going to run up my average cost. However, I might maybe I buy a smaller position. I'm not taking a full size position on the first pivot that sets up, and then it tightens up more and the base continues to form. And then it comes out of another pivot that builds either adjacent to it, maybe just moving sideways or a little bit higher. And almost always I'm buying higher. When I'm pyramiding into a stock, I'm usually buying at a higher price, not much higher though. It's still within the base. I'm always buying within the base, not out of the base. But you can see here, you have 2 buy points. So if you missed this first one, you got a second chance here. And if you had not, then you could have either added to the position or sometimes you can even trade out. If it moves up enough, you trade out and back in.
Yeah, or you could have gotten in here too. If you missed those spots, it formed a little cup and handle and then broke out and started moving again.
Yep. Sometimes you'll get small bases on top of the base. You'll get a base on base. That will happen a lot of times when you come out of a base and then the market corrects and you get some type of pullback in the market. That's sort of the best scenario, is so you can, the stock pulls back for a reason. Maybe it's a NASDAQ stock. The NASDAQ gets hit. It pulls in 7-8%. Stock pulls in and then resets and comes out. You can get yourself another buy point. But you don't want to buy up too far away from the base, because then you're starting to get extended and you're running the risk of a sharp pullback. Now, again, you can have let me get rid of those lines. I was buying this stock right here when you got very tight. You can see how that one day of volume was down to negligible volume, and then it came out very strong. This stock was the very first stock that my very first post on my blog. I had a blog at the time, and this was the first stock that I put on the blog as a stock pick and talk about a stock that I was buying, and it came out beautifully. It was perfect. But you got a pivot point earlier that I did not participate in. I saw it over here, but I could have been buying it here. And we're going to talk about that in just a second of getting in a little bit earlier on what we call the cheat area. And sometimes, again, you'll have these multiple buy points within the base. And the pivot point doesn't necessarily have to be at the old high. Again, you take a look here, you've got a nice pivot point right here. It tightens up very nicely, but then forms that handle right around the old highs and gives you another buy point. And you can see this is the buy point where it really has finished the base, because you can tell because it comes out explosively. Right here, you still had some supply to deal with. Here, this left side, you're coming up to that old high, and that stalled the stock for a little bit longer until you finally wrung out that last bit of water, right? That last bit of stock supply. And now the stock can move very quickly because there's no more supply. If you take a look at a larger chart, you can look at a weekly. This will work the same on a weekly and some larger charts, larger time frames. This is Microsoft going back into coming off the 1990 bear market. This is the bear market right here. The lows were around October. And then you set up a nice pivot point right here. You can see on the weekly, and then it comes up and real nice volatility contraction here. So this is just a volatility contraction pattern here, and then within one larger volatility contraction, and now you've got your handle. Now I call this here, this lower area that you're buying, the 3C, or the cup completion cheat, which just means that the cup portion of a cup with handle has completed, and you've got a chance to buy it a little bit lower within the base. I'll tell you how that came about. A friend of mine that used to trade back in the early 90s, we used to talk on the phone pretty much every day, and we would talk about our stocks and so forth. And we were studying the cup with handle pattern, and I started noticing, and we both started noticing this lower pivot point within the base, and started trading it. And then he would call me up on the phone and say, "Hey, did you see the XYZ?" And I'd say, "Yeah, I bought it. I cheated. I got in early." So that's how we started calling it the cheat. That we were cheating on the handle and getting in earlier. Well, that's become really my signature pattern now. We're going to talk about that in just a second, and there's even a pattern that's even a little bit lower than that. They can get in even a little bit earlier. So we'll talk about that in just a second. But I want to move to talking about the right side development of the chart, and another way of understanding how to let that right side develop is understanding the concept of what I call time compression. Now, time compression, and again, a lot of these terms are my own. You're not going to hear these anywhere else, or at least if you do, there's somebody who's talking about my work. But time compression is sort of, think of if you took the chart and you just sort of press that side, you push that side. Let me get where's my thing here? You push the chart this way and you squish from right to left, and you didn't give it that time to develop that right side. That's when the stock is moving up too fast off the lows and doesn't have the time to allow for the supply to be weeded out. Just like the towel being squeezed and the water coming out, you need to allow that right side. So you'll see when you go and look at these charts, I'm going to show you where you might have been tempted to buy it, but you shouldn't have, looking at Black Box.
And Mark, let me add to that. If you can go back, I think also to really sum it up, the left side of the chart, there should be balance and symmetry to these things. There's actually, I don't want to get carried away, but there's actually a beauty to these things, that they're very well balanced, and this left side should be equivalent to this right side. And this is the middle, and they balance each other out, and that's what you want to be looking for, especially in cups and saucer type of patterns.
Yeah, and you can get carried away, Dave. We have lots of time. If you want to get carried away, I think everybody would love for you to get carried away. Yes, so there should be a certain degree of symmetry, and I'm going to show you that right now. with Black Box, how you can see when you come off these lows, plus you have no contraction. You see, it didn't go through any contractions, but you can maybe make a case for some type of, pivot forming here. But as it comes off, now it's coming off a little too much, and you can see you need more time. And as you go through this base building, now you can see all the tightenings and how it really sets up on this right side, and you really get those few days. Sometimes the pivot point is just a day or two, and it's as long as it's really tight, it can be just a day or two, and I call that a pause pivot, and you come out of there. But now you're fully developed, and now you can come out, and that stock can explode because, again, the supply has been worked through. Let's take a look at Troy Group. This looks almost like the identical pattern, different type of chart, but very similar. See right here, this is too early. See, it comes right up, and it's a little bit sloppy here, and it needs more time. Then finally it goes through, and now we see what David and I were speaking about earlier about fractals. You see how you have a little pattern. See how that's a little tiny coupled handle? Not only is it a little tiny coupled handle, it actually has the little lower pivot that I was talking about, and then it has a higher pivot. It's exactly the same process, or going through the same supply and demand process as you're going through in the larger time frame. A very constructive development when you have the patterns within the patterns, and they're all tightening from left to right. Now here's another one where this is really compressed right side, where it just runs straight up, and you see, look, it's like a wall there, right? So you need some time to build in that right side. So now this is your buy point, not over here. You don't want to be chasing it when it's coming up this right side, because sometimes they can come in very hard, and if you're using tight stops, you're going to get knocked around because there's just too much volatility. You want to be in where the volatility is the absolute lowest, and then buy in the direction of the expansion from that low volatility.
Yeah, and let me add, if you go back to that, it's always when they come up straight up from the lows is where you run into trouble. Because I mentioned this in a previous segment, that when a stock comes up from its lows and goes right up almost, well, it actually got into new highs without really spending a whole lot of time. It's like that runner who runs all the way to the top of the hill, or halfway up the hill, and needs to catch his breath, and just doesn't have enough energy to keep on going, and that's why it has to spend more time before it gets going again.
Right. Now this running right up is a good development, especially if it's on big volume, and maybe it's on an earnings report, whatever it may be. It's a good development. You want to look for big demand, institutional demand, but that doesn't mean that that's the spot you want to buy it. And as I pointed out before, you're not looking for the lowest price, you're looking for the right price. Okay. And you're going to learn as we go along here that the right price is, it takes a number of things for you to come together. And that's what specific entry point analysis is coming to a very specific point in the chart where, in the development of everything comes together, fundamentals, everything comes together to one day that you should be buying, and really working at crafting that so you perfect seeing that over and over again, and your timing becomes really, really, really impeccable. So we're looking for institutional demand. Now, here's a perfect example. I traded Dick's Sporting Goods from this buy point right over here, but you can see this came up on upside guidance. All right, Dick's said that they thought their earnings were going to be, better than the guidance, or they increased their guidance, and that gapped the stock way up. So again, I'm not going to chase it up this right side. I'm still going to wait for the volatility contraction. There is no volatility contraction yet. Now it goes through and it gets nice and tight here on the right side, and this is where you're buying it. Again, not the lowest price, the right price. And this stock made a very nice move from there. Again, looking at going back to the MGA example, huge volume coming up right there. But is that the spot where I want to buy? No, I don't want to sit through a pullback or sideways action. I want to time this stock so I'm buying it before it makes an explosive price move, and not reacting, but timing it before that happens as it starts to make that move. Let's look at VCI. So again, talking about right side development, that Dave was talking about some symmetry. You see how it comes right here and you get a nice price spike and there's a big volume spike here. And even as it puts in this right side, you could be buying it coming out right here. But to really have the whole base balance itself out, it needed a little more time, and then it finally came out here and actually came out on a gap on very big volume. So again, letting that right side develop. Elan Corp, this is one that I traded. This was coming off of the 1990 bear market. Really just textbook, a textbook setup where you came off here in a bear market. The stock actually tried to move into new highs, but the market went into a bear market. The market topped right over here and then rolled over. The stock rolled over with the market, but then it just came right up the right side as the market bottomed in October. Very shortly after, this stock ripped up the right side, set up, and then you see those last few days, see how it gets nice and tight right there? I think I have another tool here that I can use. Yep, let's see right here. So look at this right there, nice and tight, right? And you can see the volume. The volume comes right in right here. And then as it comes out, I get to use another tool. Let's see here. As it comes out right here, you see the big volume spike. So that's just a textbook setup.
The other thing I like about this chart, and you pointed it out, is I love when you get these shakeouts. And I always look, if I'm watching a stock or I'm just analyzing a stock, I love to see these shakeouts below prior lows. The other thing is that that shakeout occurred on some very, very heavy volume. The stock traded down, and if you see this, just one little tiny, there's a little mark right there. That's where the stock closed. It closed near the high of the range. So it went below here.
So right here, you're talking about right here, Dave. I'm sorry. Let me just, you're talking about right here, that volume.
Yes.
With this little move right here, right. Taking out this previous low right here.
Yes. And it closed near the high of the day. And what happens is there are a lot of people that set stops right below this low. Well, all those stops were executed. It went right on down, but then there were buyers just sitting there waiting and bought it back up and then started building the rest of its base before it took off again.
And to add to what Dave is saying here, and I'll use a check mark for this, I love to see after you have a shakeout in the lows of the base, that's when I like to see subsequent to that, and not too long after. I want to see explosive price action and coming up the right side. And that's precisely what happened. This is, again, textbook. Now, we're getting into some nuances here, and we're going to get into more nuances, and we're going to get into really, really fine points, but we'll point them out as we go along here. These are really, very professional observations that you'll have to start bringing into your chart analysis. At first, you're going to look for that VCP and look for that tightness on the right side and really look more from a general view of it. But then, Dave has been doing this for, 45 years or so. I've been doing it for 37 years. We've seen literally millions of charts. We're looking at specific volume days and price action and really seeing the little nuances that tell the story, and everything's in the chart. I mean, it's all there in the chart. If you can get the chart right, you really don't need anything else. But if you can put the fundamentals in there as well, you really can get a powerful situation. So let me move on here, show you a few other examples, and just to make the point, the point that I want to make here is that you want to see demand in the stock, not only in the uptrend, but in the base. You'd like to see some type of real strong demand, either coming up the lows or even sometimes coming up the left side. So right here, you can see company raises guidance. Again, another upside guidance. Price spikes. I don't want to chase it up here. Okay, because now this is prone to a pullback, no base, no VCP. But I like the fact that they raised guidance. Now, here's where the market actually started to correct here, and the stock came in with the market. That's fine. As long as on that right side, I get the development subsequent to that. And again, I'm buying up here, or maybe even coming through here. And is that showing? Yeah, let me get my spotlights a little bit better. I'm buying over here, as I pointed out earlier. I'm buying at a higher price, but I'm buying at the right price. I don't want to go through all this time of waiting when I could maybe be in something else during that time. I'm trying to always compound my money and keep my dead time as low as possible, the least amount of time where money's not working. That's what I'm trying to avoid. I want my money always to be working and things that are moving very quickly. Here's another one, AMSC. So this is just going back again to other charts that we looked at before, but showing you some characteristics that we didn't point out before, like this big spike. This spiked on news here up this left side. But again, do I want to be chasing it up here? Absolutely not. That stock is vulnerable. And sure enough, it pulls in and now it goes through this nice big basing process. Then finally, you see when it gets to that very tight right side, look how explosive it is and see how efficient that move is. That's what you're looking for. Now, a characteristic that you want to make sure that you're always seeing within the base is the trend being in an uptrend, even within the current chart pattern. So you've already determined that the stage 2 is in place, that the stock is in a stage 2 uptrend, but you want all the trends to be in your direction. You don't want to be going against any trend. You want the long-term trend, the intermediate, and the short-term trend. The long-term being stage 2, long-term moving averages, above the moving averages in an uptrend, and then the current chart pattern and the pivot point all being in an uptrend, buying as it's moving up out of the pivot point. So how do you determine that within the chart? Whenever you look at a chart, you want to make sure that it does a few things. One, it breaks a downtrend, marks itself up, either in the lower third, middle third, or upper third, and then moves sideways, digests, and has that symmetry, builds that right side, and then gets above that previous high. So you have a downtrend breaks, a markup that breaks that downtrend, a pullback within the base, and then a breakout above that pullback high. Let me show you what that looks like with a chart. This is BB&T, a bank stock. So you see how it breaks the downtrend, and then you get the pivot point setting up and it builds that right side. And now it comes right out of there. And you can see this pivot point is actually lower. It's not up around the old highs. It's a little bit lower. This is what we refer to as a cheat area. As I explained before, cheating before the handle. But if you notice here, you don't really get a handle. You get a little pause up at the top here. Sometimes you don't get a handle. And that's why I like to try to, if I'm offered the cheat area, I like to try to get into the cheat area or maybe part of my position at the cheat area. Let me show you how that looks here. So this is going back to the Cirrus Logic example. And if you didn't have the benefit of seeing it in hindsight or seeing it in real time when it finally developed that handle area that I bought off of, this is what you would have seen while it was forming the cheat area. And this is perfectly viable. This is a perfect buy point right here. Again, breaks the downtrend, marks itself up, moves sideways, and then gets above the peak in that sideways action. That's just the characteristics of any good chart pattern, of making sure that you have the current chart pattern in an uptrend. Now here you go, cup completion cheat, right? And then you get the handle. So now you've been offered 2 buy points. Think of it as an elevator, that's going up some floors. You're trying to get to, say, the 10th floor, the 20th floor, but you want a few opportunities to get on the elevator. So maybe on the 3rd floor and the 5th floor and the 6th floor, and then ride it up from there. Well, think of the cheat areas maybe as the 2nd or 3rd floor, and the handle is the 4th or 5th floor. And then from there, the elevator moves even higher, hopefully at least. Here's Baidu. So you get a cheat area right here, really just perfect, comes out and then forms a little handle, breaks out of there, and this stock goes up 34% in 36 days. Again, not a huge move, but in 1 month, 30% in a month, do the math. If you can compound those out, you make a very nice gain. Here's Microsoft. Again, I was buying this right here from the cheat area. Again, another thing to mention is that cheat areas are really good to use on large cap stocks, especially if they're institutional favorites, because these stocks are more widely followed, and you get what we call crowded trades, where when you get it so obvious and you form a cup with handle and it's up around the old highs, and the chart just becomes so obvious when it's lower within the base. It takes more expertise to see that in real time. So they tend to be higher probability trades, especially with the bigger caps. With the large cap names, I'm always looking to buy the cheat area. I'm looking to buy lower within the base. With the really small cap names, those are much more, those are much less efficient. There's not many eyes on them. I can give them, to form the full base up around the highs. I'm not worried about buying them at a much higher price.
Mark, if you go back to that, I just wanted to ask a question to clarify. in a lot of low cheats, do you see a return to where the cheat where you would be buying the cheat? You know, so it broke out and it came back and got support right on that.
Yeah. So if it's going to form a handle, a lot of times it will pull back to the top of the cheat area, and again, you'll that's sort of also a test, because it really should hold that and then form that handle area. Now, if the old highs are a good distance away from where you're buying on the cheat area, let's just say, it's 15% or 20% before you get up to the old highs, you could get a trade that right from that alone that makes sense mathematically. So if you're taking, let's just say, a 5 or 7 or 8% risk on a stop, and a trip back to the old highs is 20%, that's a great risk reward trade. That's a 3 to 5 R trade, and you might just sell it and then hope it builds a handle and buy it back, or maybe trade around your position. There's a lot of things you can do. We're going to talk about position management later.
And the other thing too is when you do see it pull back and get support on that prior buy spot, and it closes, you'll see the close was right at the high of the day. That's also a lower risk area to get in. If you didn't get it down here, you could have gotten it on the pullback to that spot. And then,
that's right. And especially after it has the good close, and then next day follows through. So it's showing you that it found support back at that buy point. Now, let me just get rid of this. Okay. So many of these names, another reason to use a cheat area is that you won't necessarily get a handle a lot of times, and it depends on the type of market. Recently we had a V-shaped. Matter of fact, in 2018 we had a V-shaped recovery, and now in 2020 we had probably the mother of all V-shaped recoveries in the Nasdaq. So when you get that type of bear market bottom and it runs right up that right side, a lot of times you'll get a cheat and you don't get a handle. It just comes right out. And so you wouldn't even get a buy point, a low risk buy point, if you didn't take the cheat entry. And again, this is, something where you're looking for this in real time. So you're always going to see the cheat first if it develops. If it doesn't develop, well, then you'll see the handle. But these happen in chronological order. Obviously the cheat is lower and it would have to happen before the handle. So now, here's Green Plains.
Mark, if you can go back, this is just something I wanted to point out, and I've seen this in a few of the examples that you've gone over, is that when a stock goes through a normal correction like this, like Zillow did, you usually get 3 moves into a low. There's 1, 2, and there's 3. And that's usually when, if you've made 3 lower lows, by that time you've kind of shaken out a few people, and the correction is over as it starts up from that area. But that's something I've seen in a few of the other examples that you've shown.
Yeah, and I think that also makes sense with how I spoke about the number of contractions you'll get are generally between, or number of T's, if you will, time frames, are generally between 2 and 6. So, you come off here. Now, of course, this would be counted as 1 from peak to trough. That would be 1, and then you would have 2 and then 3. So this is a 3T. But it makes sense where, you come down a few times and then you start tightening up on the right side. You'll see that you'll usually get these 3 down and then and maybe 2 or 3 on the right side that tighten.
Yeah, look at the symmetry. You've got 1, 2, 3 down, then you've got 1, 2, 3 coming back up on the right side.
That's the point I was trying to make.
Yeah, that's great. Okay.
So now, just as you may not get a handle, you may not get a cheat. It may come up and the pivot sets up closer to the highs, and you only, once again, are offered 1 pivot point. Again, it's somewhat semantics, but it depends on where it happens within the base. And I think, let me just see here if I go back. All right, actually, no, I'm going to wait on that. Let me see here. Okay. Yeah. So you might not have the cheat, you might not have the handle, or you might have both, as we showed you earlier. And you also can get, like in QDEL here, QDEL, you might get one base that offers you the cheat, and this is a little bit sloppy over here, but it sets up another base, and see, you don't get the cheat, but you get the handle. It can happen in a number of ways. So but you have these various tools, if you will, in your toolbox, or these various entry points, and you're on the lookout for them in real time. But you should get a number of entries offered to you, in any big move in a stock, as David pointed out earlier. Again, drawing a line across the highs here, looking for volatility contraction. Here's a stock that went up 98% in 6 months. Nice, quick, big move. You see how it tightens up right into where it only traded above that area on one day and didn't even close above it. But when it comes out of here, very explosive. Okay, here's the chart. I was looking for this chart. Go ahead.
If you go back to the last one, see here again, lots of times if you miss the buy point right there, lots of times you get a second chance where it breaks out and it pulls back, and look how it pulls back.
I don't see your pointer.
There you go. Okay. You don't see my pointer?
Now
okay.
I see a line that you drew, but I didn't see when you were saying.
Oh, okay. Well, you can see the line where the stock came right back and pulled back right to the buy point. So it actually gave you a second chance right where I put the X, and then the stock really exploded. So don't get discouraged if you miss that. Sometimes it gives you a chance a week later.
Right. So the chart that I was looking for right here, we're going to, and this is going to segue us here into the low cheat. Like you heard on TV, wait, there's more. So we have an even lower cheat than the cheat. And how to differentiate these is that the low cheat will set up in the lower third of the base. The cheat is in the middle third, and the handle is in the upper third. That's how I define them. There's a few characteristics, though. When you get to the low cheat, it becomes more of an expert buy. The probability is a little bit lower. The cheat, the probability is very high, pretty much the same as the handle, maybe even a little bit better. The low cheat, you're getting in lower. So you're offered a lower price. The probability is a little bit lower, but it's being made up because you're getting, of course, in lower and you're having more profit. So they all make sense. The thing is to look at it in real time and to see which one you get first. Of course, the low cheat will develop first, and then the cheat, and then the handle. But a lot of times I like to look for the low cheat on IPOs, particularly if they're big cap IPOs, big, widely expected IPOs like a Facebook that came out and then corrected. And then once it corrects, a lot of times you can get a really nice entry point coming off the lows after it's built the base. Google did this perfectly, and you got no handle in Google. It didn't give you a couple with handle. It just gave you a low cheat here. See how it's very low in the base. There's a few things here that we're pointing out, a few nuances. You got support here, some volume right off the lows. You get a nice close, and you also go inside here. I know Dave likes to see an inside day on that right side. And then you come through that highs, and that's your buy point right there as you get through the low cheat. And of course, we know the story of Google. Of course, it went up over 600% in 40 months and much more after that. Anything to add on this? Actually, I got a longer term chart here of it if you want to look at this, Dave.
Yeah. Well, it's, and this is always something that you look for on a new issue, on a big cap stock. And look how the volume really dried up in this in that area. You'll see it right down here in the chart in the volume. The volume really dried up down there and then started picking up as the stock came through that low cheat buy point.
Right. So the characteristics of the volume characteristics with price, how we talked about, and again, I'm gonna repeat that everything we talked about previously is all built upon. So nothing negates what we talked about earlier. So again, low cheat, wherever those pivot points are, you still want the same characteristics of volume contraction within the tightness in price. Let me show you.
And let me just add on volume. A lot of people think, oh, I should have volume, huge volume throughout the entire move. Volume is most important when the stock is going through the pivot point. Is it getting the huge volume? And is it getting volume for those first 3, 4, 5 days as the stock comes through that pivot point? Once it gets up and out of there, then the stock can keep on rising on just kind of average daily volume. I like to make the analogy is it's like a stock, it's like a rocket, blasting off from the launching pad. You need that huge fuel, that huge volume to get that rocket off the launching pad. But once it gets into orbit, then it doesn't take much to keep that pushing that thing higher. So the volume can actually contract as it's going through a longer term move.
Yeah, and again, these low cheats, like I said, you can use them quite often on the bigger cap IPOs, the ones that fail and then set up after there's all the hoopla over them on the initial offering. I never buy a stock on the IPO. I always wait for the stock to go through and give me some price action, to give me some data so I can look and see if there's a basis formed and looking for that VCP action. But this almost looks like Google. I mean, if you put these two charts, I'll just go back and you take a look at them, almost the exact same setup here. And here's Twitter, and coming right out of here, up 77% in 16 days. So again, a very quick move. This is a super performance move in my book, 77% in 16 days. What a great move. And you'll see this over and over. This is Vroom, VRM. This is a recent, I saw this recently, and I wanted to point this out because you had another IPO base that went through, it came up to the old highs, and you got this sort of cup with handle, but it failed. Then it came back in and set up a little low cheat, came out of there and never gave you a handle. So this was kind of a tricky one because you first got this sort of sloppy cup with handle, and I'm sure this sucked in a lot of people coming out here under those characteristics, and then it set up, and if you waited for another cup with handle, it just moved right out and it came right from the cheat area. So again, this went up 40% in 8 days. So that's a very quick move, and you see the real excitement in action happens as you move to that pivot point.
The other thing on this stock, on Vroom, on even Twitter when it first came out, is that these are new names, and a lot of people aren't comfortable with these names. They don't have that much experience. Maybe they haven't used the products. So a smaller base buying off a low cheat in a name that you really aren't familiar with, it's really hard sometimes to pull that trigger.
Absolutely. And you've got to get used to, like we talked about earlier, you've got to get used to names that you haven't heard of, or names that are relatively new. Amazon, all these names that are household names now, their best days, and when they came out of these IPO bases, and we're going to show you those later on, they weren't known. Very few people knew them. As a matter of fact, many of these stocks were hated, and they thought that Amazon, the street, Wall Street said Amazon would never make money. The funny thing about Amazon and the internet in general is that when this all first started in the 90s, in the early 90s, and these stocks were all setting up, I was buying many of these names and bringing them to my institutional clients. The word on the street was that there's the only business that would ever make money on the internet was pornography, and that retail could never make money. No one else would make money. And the funny part of it is if you look now and you look forward, a few decades, porn is free, and Amazon rules the world and sells everything, and everybody sells retail through the internet. So the analysts got it completely wrong. Of course, I'm just told that porn's free. I didn't know that myself, but anyway, see, if we had a big audience, like we would get a laugh out of that probably.
Yeah.
So, It doesn't go over as well on the internet, just me and Dave.
I'll laugh. I heard that about 6
We need a laugh track, like in the olden days. So the mother of all low cheats is probably Tilray. I mean, this stock came off, and it gave you a little head fake here. It came out reversed, and you might have got knocked out, but then it set up another buy point. You had two chances to buy it coming out of this low cheat, and this stock went up 1,000% in 28 days. So, I mean, this is probably the the best example of a torpedo or a rocket move that I've ever seen. Wanted to point that out. Another one, ICPT. I was actually buying this stock coming right through here. Now, if you notice, this VCP is just within the context of a larger VCP. I got to see if I can get a tool to show this, but right here. So here's where it tightens up more, And if you just look, the whole base, this is the whole base, right? So you've got your load sheet right here. Then it runs up and it gives you more VCP action. And right here's another buy point as it comes through. Let's see here. Where is that tool? It comes through right here. That's your other buy point. So just, again, patterns within patterns, fractals, as we talked about. And this is a good example to, just drawing a line across, seeing where the majority of the price action is. And then as you come through there, you see very explosive coming out of there. Just going to show you a few examples. Apple, this is going back 04. You had a nice big VCP set up real tight right here. Came out of that a big base and then set up a little cheat area right here, gave you another opportunity, then came in, had a gap on big volume, came back, filled the gap, and gave you another little low cheat area. So you've got a few opportunities to buy Apple on these entry points on base after base. Now, something to to point out here is that, as a matter of fact, let me just hold on a second. Yeah, this is an example for that. So the next page is an example. We're on page 193, by the way. So the load sheet, I forgot to point this out, and this makes the point. The load sheet can be below the 50-day moving average. This is something that would go against the rules of the trend template, where you want the price to be above the 50-day. Here's the caveat. With a load sheet, some of them, or maybe a quarter of them or 1/3 of them, are below the 50-day moving average. You want the 50-day not to be in a nosedive downtrend, first of all, when it's below it. And you don't want the price to be much more below the 50-day than about 8% or so, maybe 10%, but I usually use 8% below as my limit when I'm screening. So I'll let it be below the 50-day. But if the 50-day is in this nosedive downtrend, and especially if it's more than 8% below the 50, then you have a situation where the intermediate term trend is down too much, and you might want to pass on that load sheet. But this is a perfect example of a pretty creative load sheet. You can really start to get creative with these. You can see it gets real tight here. Nice tight action, and the volume is really drying up nicely. And then you can see how it comes out. Volume comes in, you get the 1-2, and then you get another 1-2. And I should be using a little bit better pointer here. You get the 1-2 here, the 1-2 here, and you get another pivot that sets up right here. And then you get another pivot that actually sets up over here. That actually should be drawn in here, where you get another buy point that comes through here. And that's just part of the bigger pattern. Let me.
Well, and the other thing too is yeah, you're highlighting. Here's your another shakeout that's going on.
Go ahead. I'm sorry. I just erased you. Put that back.
No. That was fine. I put it in the wrong tool. But yeah, you got a shakeout that occurred really 1-2 days, and then look how quickly it comes back into that base and just keeps on building that base. That's another shakeout that you'd like to see. And then look how the volume contracted before the explosion started and the liftoff started in that stock.
Right. And again, 65%, 71 days, almost a percent a day is not too bad. So question here, just real quick, you ask yourself, is this a proper setup here? Is this a proper cheat area? And you can answer that question for yourself, but the answer is yes, it is. If you answered yes, this is a proper setup here. This would be a cheat area, and we'll take a look at that. So again, a few nuances. You see that you have nice closes coming off the lows. You've got a little volume spike here coming off the lows. Good closes here, and your volume characteristics are very nice within this base. And then you tighten up. You see how you tighten up here, and you go sideways for just a few days, and then bang, explodes out of here. See, you don't really get a handle. This goes up 100% in 14 days. And again, these are the type of moves that you want to participate in, even if you got a piece of this. If it 20, 25, 30% in just a week or a few days, you can understand how the compounding can work in your favor. So we're going to take a break. we covered a lot here. Got a lot of information. We're going to take a break, and then we're going to come back. And when we come back, we're going to talk about what you do, what you look for after you buy the stock. What tells you to hold it, maybe for a larger move, or what tells you that the stock is acting normal or abnormal, that train is coming in on schedule, or maybe the train is late and you should be questioning whether there's something wrong. What you want to see and what you don't want to see after the trade has been placed. So we'll come back and we'll cover that, and we'll take a break here.